I got paid $250,000 just to buy a self-storage facility, and I'm not the only one. One of my former coaching clients did the same exact thing. He actually got paid $50,000 to buy a self-storage facility. Now, why were we able to actually get paid to buy a storage facility? When many people say that you need to use your own money to buy an asset, to buy real estate, when we actually got paid to buy the asset, we got paid to buy these storage facilities. Well, if I had to boil it down, it boils down to focusing and being intentional on mastering relationship building, focused on contributing to others, planting seeds, giving, and just building that relationship capital, which is one of the most valuable, if not the most valuable capital you could ever raise. It's not private capital, it's not money, it's relationship capital. So when you focus on building relationships, meaningful relationships, and you understand how to structure deals the right way, you understand how to evaluate risk and really mitigate against the downfall, then you can actually get paid to buy any asset, any piece of real estate. Now, I want to be crystal clear about something. Most investors are either using their own money, maybe in some cases they're using hard money, or worse, they're not even in the game because they think they don't have access to money. And one of the things that, in fact, I recently shared this just yesterday on our Storage Wins community group coaching call, is I was highlighting the point that for everybody on that Zoom, and this applies if you're watching the video, if you're listening to the podcast, all the money you will ever need to buy any real estate you want, to buy any asset, to buy a storage facility, most likely is in your mobile phone. If you just go to your contacts list, all the money that you're ever gonna need to access to buy deals is right there. The question is, like the farmer, have you planted enough seeds? Have you cultivated those relationships? Have you been in and been very thoughtful and intentional about the relationship building process so that when you get access and opportunities to deals, that you know who to call and how to structure these deals, how to create a win-win scenario for everybody involved. So I want to actually share with you the story of how I got paid $250,000, and that is, I'm not exaggerating, it was exactly $250,000 that I got paid to buy a storage facility. And it was a deal that came across because back to relationship building, I had built a relationship with the storage broker that sold me my very first deal. I got access to the deal through a friend of mine who's a wholesaler, but there was a storage broker that he was working with. And by the way, the reason he got access to that deal first, and it was a pocket listing, in other words, it wasn't listed on the market, was because he had built a relationship with a broker. And so it's all relationship building, right? My friend slash wholesaler built a relationship with the broker. I had a relationship with my friend slash the wholesaler. Eventually, when I got into the deal and I performed, I built a relationship with the broker. And so about a year later, this broker calls me and he says, "Hey, Alex, I know you bought this 43,000 square foot facility. How would you like to own another 37,000 square feet just 3 miles away?" And so it took a while to put the deal together. I actually ended up buying the facility. It was a very interesting story, which I'll share another time, but about 6 to 7 months later, ended up buying that facility, and I bought it for $1.2 million, 100% financed by private lenders. 100%, so no banks, no hard money. It was all because of relationships I've built with others, people that had lazy money, people that had money sitting on the sidelines, and they were looking to put it to work, and they trusted me. And they knew that I knew what I was doing. They knew that I always did what I said I was going to do. And I think that's really at the heart of relationship building, is establish a reputation that when you say something, people know that you literally have to be dead before you followed through. And even then you had a contingency plan, right? And so it's taken me years to build these relationships, but I don't want that to discourage you in any way, because it all starts with making a commitment and a decision now to network, to put yourself out there, to whether it's masterminds or meetups or RIAs or just getting outside from behind the screen and shaking hands with people. Like, as they say, kissing babies, and seek to contribute. And that's how relationship building happens, right? When you're intentional about it, when you're thoughtful about it. And so I was able to, I was under contract to buy this facility for $1.2 million. But here's the interesting thing. Because I knew I was getting such a good deal and I was buying it at the right price, I was actually able to overfund that deal by $250,000. So instead of the title company receiving wires for 1.2 million to buy this facility, I actually received a wire for 1.45 plus a little bit of money for some closing costs. But essentially at closing, the company was able to wire me $250,000. Now, I was 1000% transparent with my private lenders about this. They knew what I was buying it for. They knew that I was overfunding the deal. Now, some of that money I was gonna use to improve the facility, but I was able to put over $200,000 in my pocket basically on the day of closing. So I got paid to buy this facility, and then I ended up selling this asset about 18, 19 months later. Still did very well. My private lenders got everything that I had promised them. I still, not only did I make a profit on the front end, I made a profit on the back end. And really it's interesting because it was in the form of a loan. So it's not even a profit, right? It wasn't taxable income because it was a loan. It came from the loan proceeds. Now, I'm not a CPA. This isn't financial advice or legal advice. So make sure you consult with the pros. That's always a disclaimer, deal with the professionals. So this is more of an experience share, but same thing happened to my coaching client, right? Because we had a coaching call and I shared with him, I said, hey, this deal has a lot of meat on the bone. There's a lot of margin here. I said, how'd you like to get paid to buy the facility? In other words, how'd you like to earn a healthy wholesale fee and still own and operate this thing while still giving your lender exactly what they want? Now, and so he was able to do that. He was transparent. He was clear. And that's super key. You don't want to do this in like a sneaky kind of way. You have to always, always, always operate with transparency. Be honest. Okay. When you have built relationships and the deal can support the extra leverage, then it might make sense. But here's where I want to caution you. Whenever you introduce leverage, you're introducing risk, right? So you have to be very smart about it. You have to account for, whenever I underwrite and look at these storage deals, I look at what is my likely scenario, what's the best case scenario. I also look at what's the worst case scenario, and then if the worst case scenario were to happen, what is my plan A, B, and C? How am I gonna mitigate against those risks or the downside? And I never, ever, ever buy a storage facility or any deal for that matter if it's reliant on the best case scenario. That's where people get themselves in trouble. When they buy hoping that all the stars are aligned and that everything lines up in order for the deal to make sense. And that's when even tapping into any type of debt, if you're buying in the best case scenario, can really bite you in the butt. So never buy in the best case. If you're going to leverage, especially if you're going to slightly over leverage, make sure that there's enough margin in the deal, right? Does the deal work from a worst case and a likely scenario? I even like to evaluate the deal like, okay, well, if I'm going to over leverage, if I'm going to get paid to buy this facility or this asset, and the worst case scenario happens, are my lenders taken care of, which is first and foremost my primary aim, is taking care of my lenders no matter what. Am I still going to make a profit? Does it make sense? I evaluate the opportunity cost. So you really have to understand how to evaluate risk. You really have to look at everything going on in the deal, right? Like, so if I'm not able to raise the rents and the rents are currently what they're at, or maybe even slightly below, if I'm not able to do X, Y, Z, what is this asset going to produce? Am I still in a comfortable place where I'm going to take care of my lenders? Am I still going to make a profit? And so whenever you introduce leverage, you're introducing risk. So make sure that you're assessing for that risk and you have a contingency plan if you don't quite hit your projections or your target. So, but look, here's the bottom line. You're only in a position to be able to get paid to buy an asset or get paid to buy a storage facility like I did, like my coaching client did, when you build relationships, when you understand how to evaluate deals, when you understand how to find deals. But really at the core of everything, the foundation is relationship building, right? Then from there, you understand how to structure deals, how to analyze deals, how to find undervalued opportunities with upside, and then how to structure the deal so that you have a low LTV, a low loan to value, where no matter what, your private lenders are going to be taken care of. And here's something that's really, really important. Lenders first are more concerned with getting a return of their capital, OF, of their capital, before they are interested in getting a return on their capital. I'm going to repeat that because it's so important. When you understand that lenders are more concerned with making sure that the principal is safe and secure, and that there's a path and a plan to get that back, that's first and foremost, I think, what's most important, generally speaking. And then I would say they're interested in, obviously, the return on their money. Okay, first, they're concerned with getting the capital back. Then they're concerned with, okay, what's the return that I'm going to get for lending this money out? So make sure that you use leverage as a tool, because in the hands of the wrong person, it's actually a weapon, and a weapon that can hurt themselves. The deal has to support the added leverage, and you definitely want to avoid deals that have thin margins, unrealistic projections. You never want to overpromise. You want to make sure that you're in the right market with the right demographics. That's a mistake that I made. And fortunately, because I bought right, because I bought deep with high margins, I was able to withstand a lot of the risk that came with a market that didn't have strong demographics. So look, this conversation we had in much greater depth recently on one of our Storage Wins community calls. So if you are somebody that you want to generate more cash flow, you want to build wealth without the headaches of tenants, toilets, and dealing with trauma, and dealing with just everything that might come with traditional real estate, I really want to encourage you to head over to storagewins.com. And so we can have a conversation about how you can continue to keep the focus on what you're doing if you so choose, but you can now start adding storage units to your portfolio. So head over to storagewins.com. And then lastly is make sure that you're subscribed on my YouTube channel. Make sure you're subscribed to my YouTube channel and on the podcast, so that every single week you're notified with fresh new content I'm putting out. I look forward to connecting with you on the next one.